Good morning, everyone, and afternoon for some. We're excited today. We have Brad Shepard on the line from One America, and I'm just going to do a little quick housekeeping. We might go into about a 45-minute presentation here, so just wanted to let everybody know ahead of time. And if you could just save your questions for the end, we'll type them into the chat box, and I'll make sure to get to them at the end so anybody that needs to drop off the call can do that. And like I said, I want to get started quickly, so Brad, I'm going to hand it over to you.
Oh, well, thank you so much, Allie. I really appreciate everyone's time, and of course, thank you so much to Core Marketing for allowing me this opportunity to talk about what I think is a tremendous opportunity in the long-term care planning space, and that is converting old annuities with big gains into tax-free LTC benefits. And, you know, here at One America, we are one of the carriers that really plays well in that space. And we have coined, or we like to call it tax deferred to tax free for long-term care. And of course, I want to paint the picture for everyone as to what that means. Before we do that, though, I think I probably should do a little shameless plug on One America as a company, but also, you know, we do a lot more than just annuities for long-term care. Our core business are these asset-based LTC solutions, which are either life insurance or an annuity chassis. Now, what you'll see on the screen, and Allie, I apologize, I want to just confirm that my screen is moving where you can see the slide that says concept of One America Care Solutions.
Absolutely, we're all set.
Excellent, so thank you for that. But as you can see, we don't play just in the annuity space for long-term care. In fact, we sell a tremendous amount of life insurance with long-term care benefits. And you can see that on the screen on the left-hand side. You'll see either life or annuity. We call them asset care for life or annuity care for the annuity products. Really original, right? But also then there are many different ways that clients can fund their long-term care plan with One America. So what we're going to do is we're going to highlight different scenarios and case studies around how people can do that. So we're going to talk about either qualified money or non-qualified money. A lot of the sizzle and tax benefits are certainly going to be on using non-qualified existing annuities, or for that matter, just cash or cash equivalents after tax. But then the other thing that we have is we have the only benefit that can go up to unlimited for the purpose of long-term care. And that's on the right-hand side of the screen. So I just wanted to give you a brief snapshot of the products that we offer at One America. And then now what we're going to do is we're going to start to build on this marketplace of these annuities with big gains and what can we do to help. So let's start out. Now, this is really basic to say annuities are typically purchased for these reasons. We all know this: growth, the tax deferral, guaranteed lifetime income. There's some really cool riders out there, as all of us know these days. And then the last one, which is the focus primarily, that's additional benefits to guard against catastrophic illness, right? Or long-term care. But is the client's non-qualified annuity where it should be? Even further, there is a lot of existing annuities out there, over $2 trillion. And just some quick stats, I mean, you probably see this every day of the week. You know, VA sales are in 2017 were $95 billion, $108 billion for just fixed annuity sales. It's prime and it's ripe for opportunity. But this one here is the one that really surprises me. And I have my highlighter out on the screen, my laser pointer, to show you. The average purchase age of a non-qualified annuity starts in their early 50s. And that is going to tell you a lot around some of these annuities aging in place with a lot of gain and what we can do with that. But how many of these people that have these annuities or will buy annuities, in particular non-qualified, will pass away with that? And how many are actually exercising or utilizing those income riders that are so nice on paper, but how many people actually exercise the rider? Well, if you believe Gallup, and I'm just quoting some of these things, 83% intend to use their annuity to avoid being a financial burden on their children in some way, shape, or form. But this is the one that I want to highlight. 3 out of 4, call it 73%, intend to use this annuity as an emergency fund for catastrophic illness or nursing home care. Ding, 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 long-term care, right? They never need it for income purpose, true income purpose. So now let's talk about some existing legislation. For some of you, this may be old hat. You may be very familiar with it and are going to market with your clients around this. But if you're hearing this for the first time today, or it's a review and it's like, oh yeah, I forgot about that, this is the part that is so underutilized in my opinion. Now we're going to focus on non-qualified annuities to start. And I know it's a perfect example on the screen, but I'll actually bring this to life. So let's just say that on the left-hand side of the screen, this is a typical owner of an annuity. I'll say currently she's in her early 70s. I'll say Mary. She's age 72. And when you try to talk to her about if she needs care, where is she going to get the money to pay for it, she probably stops you right in your tracks and says, well, don't worry about that. I have this annuity, wherever it may be. Let's say that annuity is $200,000. She just got her statement a couple of weeks ago, and it says it's $200,000. Now, $100,000 of that is the cost basis. Remember, that's after tax. That's funded with. And then it's performed very well, and we've got another $100,000 of gain, right? So a $200,000 annuity. Now, when you ask Mary how much she believes she has in the annuity to spend on her long-term care that she just stated that she's going to use it for, what does she think? Now, I know everyone's on mute, so you can't answer me, but you know what Mary's going to say. They don't remember the tax consequences. She says, I have $200,000. Well, we all know that's not the case, right? Because non-qualified annuities with those withdrawals are taxed as LIFO, last in, first out. So the gain comes out first, and then we get to the basis. So that's existing annuities just out there. Hundreds of billions of dollars of them sitting out there with clients. Well, let's introduce the legislation part, existing law called the Pension Protection Act. Now, the Pension Protection Act was a couple thousand pages long, but a portion of that talked about using existing non-qualified annuities for long-term care. So here's how that works. If Mary were to 1035 exchange, so there's no tax consequences to her, just 1035 exchange that existing annuity into a Pension Protection Act compliant annuity. Of course, that's what One America has. There's only a few carriers that do. What we in essence have is now 100% tax-free benefits when used for long-term care. And I'm highlighting this on the screen. When used for long-term care. Now, mechanically, how does that work? It works like this. Think of it visually as we're flipping that annuity over. We're flipping it over if there's a long-term care claim on it. And what comes out first? The basis comes out first. And then, if they use up all the basis, if Mary uses up all the basis for her care and still needs more, and she's using her gain, which would have otherwise been taxable, now every penny that comes out of the gain, which is now down here, becomes tax-free for the purpose of long-term care. Now, I hope that is either review for most of you, but if that's new to all of you, here's what we mean by that. It is truly, remember the title of my presentation today? It is truly tax deferred. They would have had to pay taxes on it one way or another down the road, right? Even, if it were to be passed on to beneficiaries when pulling those dollars out. Now, it is tax-free. So tax deferred to tax-free for the purpose of long-term care. Now, if the client never needs long-term care, it's in a deferred annuity anyway, a non-qualified deferred annuity. So it looks and feels exactly like any other non-qualified annuity as far as payouts or beneficiaries and so on. You could have been doing this since January 1st, 2010. So there are a tremendous amount of opportunities. Now, we as the carrier, One America, provide the vehicle called Annuity Care, the product, that allows us to do that because we file it specifically to use that basis first and then the gain when calculating for long-term care claims. And then beyond that, we can turn it into even more leverage for long-term care. Now, we happen to call that continuation of benefits rider. It is only available to claim for long-term care purposes, but still, that's where clients, and we like to use a saying, so I'll mention it to everyone on the line today. Try to keep the main thing the main thing. I will promise you right now, the interest crediting rates on these annuities that I'm going to be discussing in the case studies are not going to be the best in the marketplace. They're not going to be the worst. They're going to probably be right there in the middle. So people are not going to put their money into these contracts simply because they're going to get a better interest crediting rate. They're doing it, the main thing here is they're doing it for the purpose of planning for an eventual long-term care need. And how can I get the most money out of that, whether it's tax-free benefits, as I've mentioned here, or whether it's even further leverage. So here's the opportunity for all of us. Look at any client with an existing annuity that is not earmarked for income. That is very important. We don't want to touch something that they really have designed to turn into income and who currently has no plan of care in place. Now, generally, the people that put their money into these types of solutions for long-term care tend to be on a little bit on the older side as compared to using a life insurance for acceleration in long-term care. So they tend to be, call it 65 plus or 70 plus, but we can issue these types of contracts clear up to age 85, so even older clients than you would normally think. And then also clients holding annuities when income isn't needed, as I mentioned before, clients who are not exposed to the Pension Protection Act. In other words, they don't know about, like Mary, she didn't realize that she would have to pay taxes on those dollars, those gains, if using it for care. And then, of course, clients that have some existing health issues. I'll tell you a little bit about underwriting in just a few moments. So here's the concept. We're simply taking that existing annuity, which is a part of a portfolio, and we are then reallocating it. So it stays in, like in this case, the pie chart, it stays in their portfolio. So it's kind of like a left pocket to right pocket scenario, stays in their portfolio. And what happens along the way is we're just simply adding leverage for the purpose of long-term care. So depending on the product or the client, and that's where we're going to get into case studies right now, depending on the client, I mean, you can turn this into 2, 3, 4, or even up to unlimited lifetime benefits for long-term care with that existing annuity. So here we go. Let's give you a few case studies, and I'm going to try to highlight different scenarios, maybe a younger couple of people and maybe some older ones with different products so that you can understand where you can truly customize how you go to market, or depending on your situation, if you're working within a broker-dealer, you may not be able to discuss a fixed index annuity with your client in this scenario. So we want to make sure you have, think of it like levers that you can pull depending on the client's needs. Now, in this scenario, we're going to start with a female, and she's going to be age 70. And as you can see on the left here, she may have various health issues that could eliminate her from a life-based LTC plan. Unfortunately, we do see that a fair amount, right? People have health conditions as they start to get in those older years. Now, we're going to use $100,000 in an existing non-qualified annuity, or it would be, we could take it out of cash as well. It just won't have a lot of growth on it, right, if it's in a cash position. But especially if it has $100,000 in an existing annuity, maybe a portion of that or a majority of that is growth. She doesn't need it for income. Remember, we said that. The potential care need, protection, and guarantees are her priority. And this is also very important. The cash value growth is secondary to creating leverage for care. So really what she wants to do is turn her dollar into a lot more dollars if she needs care, right? Keep the main thing the main thing. It's about long-term care in this scenario. So I'm going to introduce to you a product that we call Annuity Care 2. Now, don't worry about the names of the products. I'm not here to make you a product specialist. I'm here to talk about the opportunity, to help you to be an opportunity specialist. But I at least have to introduce them to you because the core team will be the ones that will help you with plan design and which product is going to be perfect for you. But with this particular product, the highlight that I'll build on the screen right now is that the additional leverage, which is important to this particular client, is included in the premium that she pays for the annuity. Now, we can issue this product up to age 80 in this scenario. Now, this is, if you're taking notes or if you're familiar somewhat with all of our solutions at One America, I'll just give you one little extra tidbit that you may want to consider. This is the only product that we have where we can't go up to unlimited. But man, we can make this thing really, really nice for the client. So let me give you the scenario. So what we have on the left-hand side is, we talked about that $100,000, just an even number. She's age 70, $100,000 goes into a fixed deferred annuity. And that fixed deferred annuity, just on the accumulation side, is going to earn about 1.75% today. Those interest rates do change. But here's the important part to remember. We have a different interest crediting rate when the person needs long-term care. So it's almost like two different values for just her cash side or her long-term care side. And I'll show you that on a ledger in just a moment. Now, we're going to accelerate that over a 24-month period. So that's where you get the $4,167 per month for long-term care. Remember, tax-free. And then she has the option of choosing either 2.5 times leverage, which is another 36 months for long-term care, 72 months, which is 4 times leverage, or 5.5 times leverage. Either way, I want you to see this. There is no further premium due at all for the client. What pays the monthly LTC charges for all this extra leverage comes out of the accumulated value on the annuity. So what you would find, and I'll show you an example, what you would find is that, you know, the cash value may start to erode slightly for all this extra leverage over time, but it's certainly not going to erode to a point where the annuity value is reduced to half. It actually tends to fall within a 5 to 20% range of cash value, depending on what additional leverage that this lady would take. So let me give you an example. We're going to go with the 2.5 times leverage just to show you that. See how total LTC balance is $250,000, whereas her amount that she funded with was, and we're going to round it up to $100,000. Well, you can see that the cash surrender certainly does take a slight hit on this scenario, but then it starts to go back up because it's only 2.5 times leverage. To be fair, if she chose 4 times leverage, where this was a $400,000 bucket of money for long-term care, tax-free, you might see this cash surrender value or the accumulated value take a slight bit more of a hit in those years. But as you can see, it's not much. So really, what was her cost of insurance to take her $1 and turn it into $2.50 for her main thing, which was long-term care? So a lot of clients like this product because there truly is not another premium check due to the company at all. I'm going to flip the script a moment because I do a lot of email marketing, and one of the most successful email marketing campaigns that I've ever ran here at One America is this one. Yeah, it's flashy. It gets a lot of attention. But we can take $100,000 and turn it into $1 million. Now, who wouldn't want to hear that? Well, here's how we can do it. Now, we're going to say it's a little bit of a younger applicant in this case. It's a male, age 65. And this male, age 65, the first year, $100,000, as you can tell, they went with the 4 times leverage in that scenario. So we've got over $400,000 of long-term care available, but what they added was inflation options. So we added a 5% inflation option on here. And that 65-year-old male, by the time he is now age 85, it's his pool of money for the purpose of long-term care. Remember, keep the main thing, is now over $1 million. Tax-free, and not another penny of premium was due to the insurance carrier. Now, what you're not going to see is, and I can just verbalize it for you, if I showed you the ledger, that $100,000 that this gentleman put in at age 65, down the road at age 85, if he never needed care and he died, the accumulated value, that annuity would be worth about $81,000. $100,000? Yes, it was lower. Now $81,000. So his cost of insurance over those 20 years to take his $1, his $100,000, and turn it into $1 million or more for the purpose of long-term care was $19,000 of his own money. That is a great scenario to be able to show to potential clients or prospects. And remember, you're going to hear this a lot, tax-free. So now we're going to move on. Now, I do want to be sensitive because I know some of you may have restrictions around any type of an indexed, fixed indexed annuity type chassis, but we are the only carrier that today that we're aware of that has a fixed indexed annuity with all of those great pension protection benefits for long-term care, tax-free. So let's go through some scenarios. But first, some of the product features around this type of scenario is that it is just like most fixed index annuities, that it's benchmarked to the S&P 500. It's a 9-year surrender, 10% surrender charge-free withdrawal after the first contract year, and there are no fees, charges, expenses, or spreads. We're trying to keep this truly as vanilla as possible because we want to give the most long-term care benefits. So what I want to highlight here as far as the product, don't worry about all of the other stuff, but we can take this one back up to age 85, so we can issue up to age 85, and then we can also go clear out to unlimited benefits on that extra leverage in the additional rider if they so choose. I will highlight one other thing because I said I would, and that is you can, depending on the state and if you're allowed to do so within your distribution, we can also accept qualified money into this scenario. Please keep in mind, though, a qualified funding of this type of product is not eligible for tax-free benefits for long-term care. I just have to be very clear. I don't want to steer anyone down the wrong path. The only way we get tax-free benefits of gain is in a non-qualified annuity. Okay, so let's give that case study that I promised to you. We're going to use a female, a little bit older this time, age 81. Now, her age, health issues, or other tax adversity from funding source has eliminated her from a life-based LTC plan. We do see that a lot, as I mentioned before. We're going to use a slightly higher amount because there's a lot of these bigger annuities just sitting out there. So we're going to use $250,000. It's in an existing non-qualified annuity or in a cash position. Really, the sizzle on the steak is going to be in that non-qualified annuity. There's no need for income, as I mentioned a couple of times. The potential care need, safety to her, and guarantees are her priority. Cash value growth is also desired. That's very important in this example. She wants to see her dollars growing. And then, like I mentioned before, that you are familiar as the writing agent with an indexed structure. So what we're going to introduce to you is what we call a base-only strategy. None of that additional leverage. And then I'll show you the leveraged option as well with the same scenario. But I want you to see this because whether it be for underwriting purposes or because they just feel they don't need any additional leverage, you can still help the client out with all those tax-free benefits. So here's how it looks. You got the $250,000 that goes into the fixed indexed annuity, even if all of that is in the fixed account, right? That doesn't have to worry about caps or pars if you don't want to. It can just be in the fixed account, no worries. And what we're going to do is accelerate, if she needs care, we'll accelerate that over a 24-month period, which would equate to over $10,000 per month of long-term care. Remember, tax-free, no matter how much gain is in the $250,000. So to her, that is going to be important because of some of these reasons, these advantages. In a fixed index annuity, inherent in most of them, and especially in ours, there is a guaranteed increased multiplier step up for long-term care. And I'll show you that in a ledger right now. But also underwriting. There's no tele-interview. There's no interview over the phone. It's just purely knockout questions on the application. We do an RX check and an MIB check. So it's much less underwriting for the client. And she can use her own money penalty-free. So we don't imply penalties, even if they issue the contract today and 2 months from now, she needs it for care. There's no penalties or surrender type fees, and she can use it over a 2-year period tax-free. So here's the ledger. And I wanted to highlight with this arrow to show you the account value. So with that step up for long-term care, there's downside protection, right? And we all know what fixed index annuities do with protection from losses and then potentially taking advantages of the gains. Well, I'm going to show you that here. So the account value, cash growth to her, or at least not losing anything, was important, right? So you'll see that she never loses. There's a guaranteed return of premium on that scenario. But look at the LTC benefit balance. Over the years, that continues to grow even higher, which then also means that the amount per month that she can pull out for long-term care purposes, because we just simply accelerate that over a 24-month period, also grows. Now, I don't want to call this built-in inflation protection, but you can connect the dots. The monthly benefit for long-term care will grow over time because of that step up for the purpose of long-term care. So that's the downside protection. Now let's look at the upside potential here. We also have a step up on the long-term care, which if we are crediting higher than the guaranteed interest crediting rate of 1%, you would see that that account value is actually going to grow even more. So you can see she put in 250, and as time goes on, that's growing even more. But then look at the LTC benefit balance. Much, much higher. And then, of course, the long-term care benefits on the right-hand side here started with 10,000, a little bit over 10,000, but now 10 years later, it's at 13,390 in my example. So how do we do that? I want you to see this because this is also in the policy when it's issued, but I just want to highlight something. You can see it's on red font on the screen. But how do we do that? Well, the LTC benefit balance that we calculate for the client, that downside protection and potential for upside, how we do that is we give the greater of the account value multiplied by the account value multiplier. That's this column right here. It is a illustrated grid of what those values will be as you go through the contract years. So they get the greater of that, or the net single premium multiplied by the adjusted net single premium factor. That's this one. So either way, the client's going to win, and they're going to get the greater of that. So in this scenario, when you do the numbers, and you look at down the road 15 years from now, we can see that it's either 300,000 times the account value multiplier, or the original account value times the adjusted net single premium factor, which is 1.35, so they get the greater of that. So in this scenario, the client started with $250,000 in the contract, and now 15 years down the road has over $345,000, and it doesn't count any of the additional leverage if they were to purchase for long-term care. So let me show you that now. And I know I'm going pretty fast today. It's purely because, one, I want to keep your attention, and two, I just want you to be thinking about scenarios, maybe potential clients or prospects that are out there that you can show these types of contracts too. So now we're going to use that same fixed indexed annuity, but we're going to add leverage to it. And you know what? Let's go for it. Let's go for unlimited benefits. So now this 81-year-old who thought they could never get long-term care protection gets all of their money that they put into the annuity tax-free, but then we're going to have to use a portion of that if they want to pay for the rider in a single premium. So yeah, it's pretty substantial, but now they get unlimited benefits for long-term care if they pass through underwriting. Now, what does that turn into? Look at this. So $250,000, portion of it paid for all the extra long-term care, and a portion went into the annuity. That turns into over $7,000 per month for this client, for this young lady, this 81-year-old, for life, guaranteed. Now, if you just put a calculator to this, that means that she would have had to earn 34% interest rate on her money in order to get $7,000 per month for long-term care forever. And as we all know, that's just not possible. So you can really turn this into a tremendous amount of leverage. Now, I'll take a quick time out for a moment. You may say, hey, Brad, I have a lot of clients that have, existing annuities with a 3% minimum, 3% guaranteed interest rate on them, depending on when they were purchased. There's no way this is going to pass suitability. Well, the answer is yes, they will. Because you've taken, even in this scenario on paper, there's no suitability or compliance department that will not approve you putting that client in a better position for the purpose of long-term care than what you've done even in this scenario and any of the other ones that I've shown you. I've never seen suitability not be passed when you're taking them from their current position, even with a 3% rate, to what you can do here. All right, next. Now, for those of you that, thank you for still paying attention, but maybe can't sell the fixed index annuities, or that's just not something that you want to do, we still have the ability to take that benefit out to unlimited. And that's just our straight up annuity care product. Don't worry about the name, but that goes back to that age 85, and we can still go out to unlimited benefits. So really, it has just one less option, but don't worry about that. Now let's take another case study. So yes, we're going to use a little bit of a higher age person again, female, age 81. Age, health issues, or tax adversity, funding sources eliminated her from life. Sounds familiar. She's going to use $125,000 though in this scenario, and it's in an existing non-qualified annuity or cash. Remember, more benefits on the non-qualified annuity because of the gains coming out tax-free. But the client is unable or unwilling to generate income for that extra rider, right? All that extra leverage, but wants lifetime. We actually see this more than you would think. Potential care need and safety and guarantees are also a priority, but they're unable to place indexed annuities, as you've already heard me say. So for those of you that can't use the fixed indexed annuity chassis. So here's what it looks like. $125,000 in the annuity. We're going to use a portion of that, though, to put into the base policy of the annuity. And then of the 125 at age 81, it takes a little over $22,000 to fund unlimited benefits for this client. Now remember, that $22,000 that comes out of the existing annuity in the 1035 exchange is also tax-free. Even paying for premium is tax-free for long-term care. So when we accelerate this base policy of a little over $100,000 over a 36-month period, that gets you this $36,000 per year, tax-free forever. Now back to my question. What kind of interest rate would that client have needed to get on the $125,000 to generate $36,000 a year for her stated purpose, needing it for care? It would be almost 30%. So 20% guaranteed interest rate you would have to earn on those dollars to generate that. So I hope what you're hearing me say is, for the purpose of long-term care, there's really not a better vehicle to do this with, especially if there is an existing annuity out there. Now I'm showing you the ledger here for this particular scenario, But I also want you to see that the accumulated value on the contract for cash is going to be lower, like I mentioned before, because we actually credit a higher interest rate for the purpose of long-term care, which then carries over to even more benefits on the monthly side for that purpose. So we're almost finished, and I promise it'll be less than a couple of minutes here. We're going to finish with some ideas around underwriting. Now, with annuities as compared to life insurance underwriting, as you all know, it's much less with annuities because, the insurance company isn't on the hook for the extra death benefit. That's just insurance 101. So in this scenario, as I mentioned briefly a minute ago, there are no APSs at all and no paramed exams like you would see on some life cases out there. If the client chooses to have all those extra benefits for long-term care in the form of the rider, there's a brief 15 to 20-minute phone interview underwriting for that purpose. And if they so choose to not have those extra benefits, there's no telephone interview at all, and it's just simply knockout questions on the application. We'll do an MIB check and a prescription drug report just to make sure they're telling you the truth. Okay, last couple of ideas. So I hope this has been, thought-provoking, and you've been thinking about different scenarios and clients that you could use this with, but I want to throw out a couple more. And that is, we do see quite a few annuities that have been purchased for whatever reason, right? We don't question that, but purchased 10, 15, 20 years ago in a couple situation where it's only a single owner annuitant, but yet they want to use those dollars for one of these long-term care plans. Well, we all know, like for like rules with 1035 exchanges, you can't do that, right? You can't go a single owner annuitant to a joint. Well, we have a way around that. Now, it's all legal, completely legal, but we call that eligible person. And that allows for a spouse to be added to the contract for the purpose of long-term care. They can't make financial decisions on the contract, but all those great tax-free benefits for long-term care I've been talking about for 30 minutes, that spouse can now use that. Of course, keep in mind, both have to be insurable, so it can't be based on just the owner annuitant. Both have to be insurable, but that's a great way to almost have like a joint benefit for the purpose of long-term care and still following all of the same 1035 exchange rules. That's called eligible person, and you put it right on the application. And next, so as you're uncovering, different clients or thinking about different clients that may have some of these old annuities out there, some of those old annuities are actually being pretty large. I mean, several $100,000. I actually saw one about 2 weeks ago that was over $1 million, and that is wonderful. But then you say, well, wait, maybe I don't want to put all of that into one of these products, which is more than fair. And then the other problem is the other carrier that has the existing annuity, some of them don't allow for partial exchanges. I've never understood that, but they just don't allow for it, right? Don't worry, you can still solve for this. So let's just say a client has, I don't know, $500,000 in an annuity, but yet a portion of that, they want to fund one of these products I keep talking about. Let's say it's $200,000. I don't know how much, but let's just say it's $200,000. They need to find a place for the extra $300,000, right? Well, they can park in what we call a transfer annuity, the $500,000, put the amount that they wanted into our product called annuity care, and then the remaining amount, I used $200 into our product and $300,000 into the next one. They'll have another approximately a month to find a home for that other money. Maybe there's a better interest rate. Maybe there's a better income rider. Maybe there's something else that interests the client. We can do that, and we call that our transfer annuity. All right, so I promised that I was almost finished, and we didn't quite go to the 45 minutes, and hopefully you have some of your time back. But Allie, I know that there probably were some questions that were either typed in or thought about, so for those of you on the line, please type in any questions that you want me to answer. And I'll also say before you open up the questions, Allie, that I am more than happy to send along this presentation. It is for training purposes only, right? Not to be shown to clients, but for training purposes, I'm happy to send this along so you can have a copy of it in case some of you were attempting to take notes along the way and maybe I was going too fast. So Allie, I'll turn it back to you for any questions that are in queue.
Thank you so much, Brad. I'm not seeing any questions popping up currently in the chat box, so if anyone has one, we'll give a few seconds. And maybe while you're typing, I'll just mention that presentation and supporting materials will be available on our website through the advisor portal. So I usually send that link out after the fact to attendees and anyone that's missed the presentation today that's signed up and wanted to attend. So you can share it with any colleagues as well. All right, we have a question.
Oh, excellent.
Here, I'm going to pop it out. Oh, there were questions, maybe bigger. I'm trying to make it bigger. Sorry, everyone. Can you do this with a 403B or IRA?
Okay, so the answer is we can. Now, keep in mind, I know I talked a lot about those tax-free benefits for long-term care. We can put those qualified dollars into one of the products, and don't worry about the names of them, but we can put it into the fixed index annuity or the straight up annuity care product. And the key to that though is because think about the base policy as the annuity, or it doesn't matter if it's annuity or life in this scenario, but it's almost like that's the golden ticket to the pot of gold, which the pot of gold is those extra benefits for long-term care. So what we would recommend in that scenario, if you use qualified dollars, is use the qualified dollars for the base annuity, but pay the rider with after-tax dollars, whether that's just a single premium or whether it's just a recurring premium, even down to monthly premiums that are guaranteed to never go up. Pay for that with after-tax dollars because then all of those extra benefits are completely tax-free. One final thought on that is that if you're thinking about 403B or any of those scenarios in a qualified situation, you may want to also consider, I didn't have it on my presentation today, but I'll throw it out since you asked. We have SPIAs, immediate annuities, where you can take that qualified money and fund one of the life policies that could go clear out to unlimited as well. So that would be for a scenario where your client is a little bit healthier, right? They don't have to be perfect by any means, but a little bit healthier, and they want some of those extra benefits in leverage. And of course, those premiums in the SPIA are funding life insurance. So now you have a tax-free death benefit as well. So sorry I'm long-winded, but I wanted to throw everything out there because there's a lot of great scenarios using qualified money, whether it be in the annuity or to fund one of the life products too.
So on that, there's another question was inherited non-qualified annuities. How would that work?
Yeah, so we have some rules around that, and I'm happy to follow up. Some of these cases we have to take kind of one-off or offline to find out more particulars, but there are some parameters as to the age of when that occurs, that inherited, and how we do that. But the answer is, in most scenarios, we can actually help you with that too. And I'll give another shameless plug. Even if I personally don't have the answer to that potentially very sensitive or high-level question, we don't want to get that wrong. We have a team of advanced market attorneys that help us behind the scenes, help you also behind the scenes so that we can structure things properly, make sure that it's the most efficient tax-wise, we're following all codes and laws, and then also maybe consider some options that we didn't think about before. And that could even be scenarios where, you may want to have a trust own one of these products. We can do that as well. So, we have teams of advanced market attorneys that'll help us with that as well.
Okay. Sorry, we've got more questions popping up that I'm trying to get to.
Sure.
If using qualified money, what about RMDs?
Yes. So we structure most of these contracts to either meet or be very close to satisfying RMDs on the contract. So keep in mind, if they're, we will take every scenario and make sure that we're putting the client in a better situation. Now, if the client is not going to be exercising any income off of the annuity in this example, then what you're going to have to account for is once they reach that age 75, 70 and a half, as we all know, that's when the RMDs kick in. So we're going to have to account, if they're not going to use a portion of this in any way, shape, or form for income, which we don't see very often, but if that's their approach, then you want to make sure you can account for that RMD in another part of their portfolio. I've never seen it as an issue or like a stopper of someone buying the product. And quite frankly, we tend to try to find more of the non-qualified dollars if possible, so that we're not running into the RMDs. But when that does happen, we just have to fully disclose that they'll have to account for some of those RMDs elsewhere in the portfolio, which in many cases isn't an issue, for the client that's going to put their money into these types of products.
Okay, and then we have one, explain more on the loss of tax-free benefit on qualified money. Why does this happen?
Yeah, so that's just a law thing, right? Legislative thing. As a part of the Pension Protection Act, they isolated out non-qualified dollars. Because if you're the government, think about it, if you're the government, you're actually losing tax revenue when those gains come out tax-free. Now, the government was willing to lose the revenue on non-qualified products and solutions, but not on qualified, because with qualified, as we know, you're not paying taxes on that every year until you withdraw. And that's why the government said we're drawing the line on only qualified solutions that can come out tax-free. Really what you're hearing the government say is that we wanted to find a way where we could incent people to do something about their long-term care, because as we all know, Medicaid is really the backstop for people spending down their dollars to fund long-term care. And that's the number one or number two expenditure at every single state level is Medicaid. So the government was willing to use non-qualified dollars tax-free, not qualified dollars.
Gotcha. I've got two more questions. It looks like are the LTC insurance cost guaranteed? So I think the riders is what that question is referring to.
And I love that question. So the answer is yes, yes, and yes. Contractually, everything that you see that I have shown you in the form of premiums in any way, shape, or form is contractually guaranteed to never go up.
Perfect. Thank you. One more here. Is there an annuity that will hold non-qualified money to pay for LTC with no leverage for those who can't qualify through underwriting?
Yes. In fact, and I'll even go and show you, I'll quickly go back to the slide that shows you that. Just take me a second. Excuse me for flying through the slides again on the screen. But it's this one right here, which is, we call this our base-only strategy. So in that scenario, now there will be, we call them knockout questions, but they're the normal knockout questions for, the real bad underwriting issues. So if the client does have a really bad health history and they wouldn't qualify for the base-only strategy, the fallback to that, and I know there's a couple of carriers out there that still sell some of these medically underwritten SPIAs. You can search for those, but you could also consider, and this is really going to be plan B, but you can consider, we have a product, and please just write this down. It's called Legacy Care. And Legacy Care, now we do not file that for the true Pension Protection Act benefits tax-free. That's just not going to happen in the industry. But what you would see there is some additional leverage. If they were to use it for long-term care, we'll add an extra 5% bonus to the payout on that. And then we issue that up to age 99. No underwriting at all because there's no true additional leverage that we provide at the carrier. It's a fallback position, but then it also handles one other scenario. And we get a lot of these in where existing annuities are being forced into annuitization, right? At older ages, call it late 80s, early 90s, somewhere in that ballpark. Well, now you have a home for that. Our product is called Legacy Care, as I mentioned. And those things tend to be rather large, 3, 4, 5, 600,000. Last year I had 2 $700,000 cases where we don't force them into annuitization because that's important to the family. You know, they want all of the deferral, but then they also, for bypassing probate, they don't want to have that forced annuitization. So we provide that, never force annuitization. You know, it's earning a little over 1%, so it's not going to be great on the interest crediting rate, but that's not the priority. The priority is they don't want it to be forced into annuitization because it would potentially put the client in a different tax bracket. They didn't need it for income, and quite frankly, they want it to pass along to the beneficiaries, their family.
Thank you, Brad. There's one more question on here, but I think it's just a one-off, so I'm gonna connect you via email. And then anybody else, would you mind giving everyone your email if they have any other additional questions?
Not at all. I mean, I'm very happy to help anyone, whether it's personally or within my sales support team. So my email is Brad, so BRAD, .Shepard, SHEPARD, @oneamerica.com. One America is spelled out, so ONEAmerica.com.
Wonderful. We thank you so much for your time. I don't want to take any more of anybody else's time today, but I appreciate it so much, and we had some great engagement here, so we appreciate it. And I hope everyone has a wonderful day. Thanks, Brad.
Yeah, and I'll just close with the same 2 words that I started with. Thank you very, very much, not just for your time today, but also for, you know, you're doing all the hard work out there with your clients. And yes, we want to support you in every way possible through our relationship with CORE. And thank you so much for the business. I hope you have a wonderful rest of your day.
Thank you.